Part 1. The Fibonacci Mystery. Today, we're going to peel back the curtain on one of the most misunderstood tools in technical analysis, the Fibonacci Retracement. Most retail traders look at Fibonacci and see a bunch of colorful lines. They treat it like a magical predictor of the future. But Fibonacci isn't magic. It's a reflection of human psychology and market geometry. The problem is that 95% of traders draw these levels from random peaks to random valleys without understanding the underlying market structure. They buy at the 50% level just because it's there, and they get stopped out because they ignored the trend or the liquidity. In this video, I am revealing the T.L.L Method, a systematic framework that turns the Fibonacci tool into a high-precision sniper rifle. This method isn't just about lines on a screen. It's about aligning yourself with the institutions, the smart money that actually moves the price. We will cover the exact TradingView setup I use, the 3 pillars of market structure, and the anatomy of a liquidity sweep. By the end of this masterclass, you will never look at a chart the same way again. Let's get to work. Part 2. The anatomy of the tool. Before we can trade, we must calibrate our instruments. The Fibonacci sequence was discovered by Leonardo of Pisa in the 13th century. It appears in nature, in architecture, and yes, in the financial markets. The golden ratio of 0.618 is the point of perfect balance. In trading, we use this ratio to identify where an impulsive move is likely to correct before continuing. Let's set up your TradingView. Most default settings are a mess of unnecessary levels, like 0.236 or 0.786. For the T.L.L method, we want extreme clarity. Open your Fibonacci settings and uncheck everything except 0, 38.2%, 50%, 61.8%, and 100%. These are the critical zones of institutional interest. Visual clarity is a trader's best friend. Remove the background colors and set the lines to a neutral color like white or gray. Change the values to percentages instead of decimals. We want to see the market as a series of pullbacks: 38% pullback, 50% pullback, 61% pullback. Why these levels? Because the golden zone between 50% and 61.8% is where the highest volume of institutional buy and sell orders reside. Part 3. Pillar 1. The real market structure. You cannot use Fibonacci in a vacuum. You must understand the 3 pillars of structure. The first pillar is the uptrend. In a healthy uptrend, the market creates higher highs and higher lows. But here is the professional secret. The move from the higher low to the higher high is the impulsive move. This is where the big players are pushing the price. The second pillar is the downtrend, characterized by lower lows and lower highs. Here, the impulsive move is to the downside. The third and most dangerous pillar is the range. This is a sideways market where price is trapped between 2 levels. Retail traders lose most of their money here because they try to use trend-following tools like Fibonacci in a market that has no direction. To trade the T.L.L method, we strictly ignore the range. We are looking for high-velocity impulsive moves that break out of structure. When a previous resistance is shattered, that is our signal that the trend is established. Only then do we pull out our Fibonacci tool. We draw it from the very beginning of that impulsive surge to its absolute peak. Part 4. The T.L.L method, trend and level. Now, let's decode the T.L.L method. T stands for trend. This is your primary filter. If the 1-hour trend is bullish, we only look for buy setups on the 5-minute chart. Trading against the trend is like trying to swim up a waterfall. It's exhausting, and eventually, the market will crush you. The first L stands for level. This is the secret of Confluence. We don't just look at Fibonacci levels in isolation. We look for level alignment. We want our 50% or 61.8% Fibonacci level to overlap with a key level from the past. For example, a previous resistance peak that has now been broken should act as a floor. When the golden zone aligns perfectly with a former resistance, it creates a high interest zone. This is where institutional algorithms are programmed to re-enter the market. It's no longer just a line on a chart. It's a physical barrier where demand is guaranteed to outweigh supply. This is how you find the exact price point where the big banks are waiting for you. Part 5. The final L, the liquidity sweep. This is the part that separates the pros from the amateurs. The final L stands for the liquidity sweep signal. Have you ever noticed that right before a big move, the price briefly dips below a major level, triggers everyone's stop losses, and then takes off? That is a liquidity sweep. The big banks need to sweep the market to get enough orders to fill their massive positions. We do not enter the trade when price first touches the level. We stay patient. We wait for the fake out. We want to see a candle pierce through our golden zone, grab the liquidity below the 61.8% line, and then violently close back above it. This price action creates specific candlestick patterns: the pin bar, the bullish engulfing, or the hammer. When you see that long wick sticking out below your Fibonacci level, that is the smart money leaving its footprint. They have just wiped out the retail traders and are ready to move the price higher. This is your green light. You enter the trade at the close of that confirmation candle. Your entry is backed by the trend, validated by the level, and triggered by the liquidity sweep. Part 6. Case Study: The Bullish Sniper. Let's look at a real-time example on the XAU. Step 1. We identify the trend. The market has just broken a major 5-minute resistance level. We are now in a confirmed uptrend. Step 2. We identify the impulsive move. Price surges from 0.655 to 0.66. We draw our Fibonacci from the bottom of that surge to the top. Look at the 50% level. It aligns perfectly with the broken resistance level from 10 minutes ago. This is our level confluence. Now, we wait. Price starts to retrace. Retailers start selling, thinking the move is over. As price enters the golden zone, we see a massive spike down a liquidity sweep. A hammer candle forms, sweeping the 61.8% level. Execution: we enter buy at the close of that hammer. Our stop loss is placed strictly below the wick of that hammer. Why? Because if the price goes below that wick, the liquidity sweep has failed and the setup is no longer valid. Our take profit is set at the recent high, aiming for a 3-to-1 reward to risk ratio. Look at the result. Price reverses instantly and hits our target in 3 candles. Part 7. Top-down analysis and risk management. To become a master of the T.L.L method, you must adopt top-down analysis. A 5-minute setup is meaningless if it is fighting the 4-hour trend. Always start your day on the daily or 1-hour chart. Identify the overall order flow. If the big picture is bearish, only look for sell setups where a Fibonacci level aligns with a previous support turned resistance. Never forget that trading is a game of probabilities. Even the perfect T.L.L setup will fail sometimes. This is why risk management is your shield. Never risk more than 1 to 2% of your account on a single trade. If you have a $10,000 account, a loss should never cost you more than $100. By using a 2-to-1 or 3-to-1 reward to risk ratio, you can lose 50% of your trades and still be highly profitable. Conclusion: the disciplined trader. Trading with Fibonacci and the T.L.L method requires extreme discipline. You are no longer chasing the price. You are a hunter waiting in the bushes for the market to step into your trap. Trend, level, and liquidity. If one is missing, there is no trade. Be patient. Let the retail traders lose their money while you wait for the high-probability institutional footprints. If you want to download my T.L.L method checklist and my custom Fibonacci settings, join our Telegram community using the link in the description. We post real market analysis every day to help you sharpen your skills. If you found value in this masterclass, hit that subscribe button, like the video, and leave a comment. What is your biggest challenge with Fibonacci? Thanks for watching, stay disciplined, and I will see you in the next lesson.